As one of the world's 4 biggest food processing and commodity trading companies, Archer-Daniels-Midland, or ADM, is a key player in the agriculture and consumer staples sector. But despite their strong market position and their ability to stay strong in an environment of limited global crop supply due to the war in Ukraine, their stock price is down 35% from their all-time highs, due to a weaker than expected earnings forecast and a recent scandal about their accounting practices. That brings the dividend yield of this dividend king up to over 3.2%, well above the long-term average. So if you want to know if ADM is now a buy or if the risks outweigh the chances, stay tuned, because in this video I will dig into the business models and the markets of ADM, analyze the strategic position by doing a Porter's 5 forces analysis, and have a look at the latest financial statements to see how they are doing. I'll also check the valuation and do a discounted cash flow calculation to determine their fair value. In the end, I will tell you my plan, how I will proceed with ADM, and if I think that they are a good long-term investment or not. My name is Florian, welcome to Cashflow Maniac. The ticker symbol of Archer-Daniels-Midland is ADM, and they are listed on the New York Stock Exchange. They are working in the consumer staples sector and were founded in 1902. They have around 41,000 employees at the moment, and their headquarters sits in Chicago. The market cap sits over $30 billion right now. ADM is a real behemoth when it comes to the food processing industry. They have services all over the value chain, and they are divided in 3 different segments. The first is their agricultural and oilseeds service, marked in green here. Second is their carbohydrate solution sector, and last but not least, their nutrition sector. In the agriculture and oilseed sector, they manage the global supply chain of agriculture raw materials, including the procurement and the storage of grain, merchandise, transportation, and the processing. It plays a crucial role in producing oilseed-based products for various industries, with a notable equity interest in key ventures worldwide. In the carbohydrate solutions, they engage in corn and wheat, wet and dry milling, and this segment produces a diverse range of products for the food and beverage industry, including sweeteners and starches, flour, alcohol, animal feed and ingredients, and also ethanol. In their nutrition segment, they also serve markets like the food and beverages, nutritional supplements, and animal feeds. And here they manufacture and distribute a wide range of different ingredients like flavors, specialty ingredients, and solutions for health and wellness like plant-based proteins or special formulas. They also serve the animal nutrition industry, mostly for farm animals. So their customers mostly come from the food and feed industry. They are fuel producers, or they come from the industrial sector and use the processed raw materials provided by ADM. The agriculture services and oilseed sector makes up the vast majority of their business. You can see here it's more than 3/3 of their revenue. This is followed by the carbohydrate solution sector and their nutrition sector, which only makes up around 10% of their revenue. Geography-wise, they are a bit more diverse. Even though the majority of their revenue still comes from the US, you can see it's around 1/3. This is followed closely by Switzerland, Cayman Islands, Brazil and Mexico, Canada, UK, and a lot of other countries, including a couple of Asian countries. Archer-Daniels-Midland belong to the so-called ABCD companies. These include Archer-Daniels-Midland, Bunge, Cargill, and Louis Dreyfus. These are the world's largest commodity traders, and they have a significant impact on the modern agri-food system. They are also dominant traders for grain globally, and that makes them very central to the food system. But how did they come here? From the foundation of the company, they have put a huge focus on acquiring other adjacent companies and vertically or horizontally integrate them to their portfolio. They do this in order to enhance their service offerings of their customers and to increase the value chain that they can provide to their customers. In the recent history, we can see that they even had a couple of acquisitions every year. But not only are they acquiring new companies, they are also spinning off segments that they are no longer interested in or that no longer fit into their portfolio. This also fits very nicely in their current priorities. Here we can see one of the biggest priorities for the next year is actually the drive for excellence, how they call it. This is their effort for cost reduction and increasing their productivity. We can see this in this point here where they want to save $500 million of cost reductions over the next 2 years, but also in this simplification step here where they want to reduce their production lines and the number of brands they currently own. Another of the focus areas is actually the production of ethanol and biodiesel. And they just increased their capacity for this with their green bison crush and refining plant and their plans for the Marshall starch expansion. With this, they are also following the global trend of renewable energies and green fuel. But not only this, we can also see that in their portfolio optimization, they are targeting an enhanced M&A integration approach so that they are able to integrate newly acquired companies more quickly and more efficiently into their portfolio and to streamline their business and their systems over all segments. As an investor, it is always very nice to see that the company also returns a lot of their cash to their shareholders. They have grown their dividends for 51 consecutive years now, which makes them actually a dividend king. And they also just announced a new share buyback program of $2 billion over the next 2 years. As mentioned in my intro, there recently has been an accounting scandal at ADM. Basically, the SEC and the Department of Justice have found some certain accounting practices of ADM's nutrition segment and their intersegment sales. At the moment, it seems like these accounting practices are linked to the bonus program of ADM's managers. And with these practices, they basically could increase their own bonuses. And according to the latest information, it also seems like the investigation regarding these accounting practices is limited to the nutrition segment, which is only less than 10% of their revenue at the moment. Still, it is always a bad sign if the Department of Justice gets involved, and this is also not the first time that this has happened. In the last 30 years, ADM has been involved in several scandals, starting from the lysine price fixing investigation, which was even adapted into the movie The Informant with Matt Damon, to alleged tax dodging in Argentina and even violations of the Foreign Corrupt Practices Act. So this new scandal is only the latest one in a series of attempts to circumvent the law in order to increase the profits of the company or its representatives. To me, these repeated scandals are an indication to a management culture that is mostly focused on their own profits, and I would not exclude similar things to happen or surface again. We also can't dismiss the risk that this current problem gets bigger than it currently is, although I don't believe this right now. The company itself states that because these practices only occurred between the intersegment sales, there is no impact on the company consolidated balance sheet or the statements of the earnings. Let's have a look at the strategic position of ADM by doing the Porter's 5 forces analysis. First of all, I would estimate the threat of new entrants in this market as low. The barriers to enter are quite high, and ADM's strong position and high capital requirement, the regulatory difficulties and the broad and well-established logistics, supplier and customer network makes it very difficult for new players to enter here. The threat of substitutes is medium to low. These raw materials are essential for food and fuel production, but they can also be replaced quite easily with alternatives or competitor products if the price is too high. The broad portfolio and the size of ADM still gives them some power though. The competitive rivalry in this food processing market is very high, especially between the 4 biggest players, the ABCDs. The competition is fierce. In addition, there are also some smaller regional players that can put pressure on ADM. The bargaining power of the customers is also high to medium. ADM's customers include food and beverage manufacturers, animal feed producers and fuel producers. These customers have significant bargaining power as they can easily switch to other suppliers. But ADM's scale, diversified product portfolio and usually long-term relationship with their customers lowers the power of their customers in this case a little bit. The bargaining power of their suppliers, on the other hand, I would estimate is quite low. The scale and vertical integration, including the ownership of transportation vehicles like ships or train cars, but also processing plants and storage facilities, give ADM a high degree of control. The global and diversified nature of this industry and the size of ADM also gives them a high degree of power over their suppliers. What I'd like to mention in addition here is that this commodity market is very volatile and dependent on factors that ADM cannot control, like weather conditions, macroeconomic conditions, and due to the global nature of this, also geopolitical risks. So even though ADM's strategic position is quite high, the highly competitive rivalry in this market, coupled with the cyclical nature of this, makes it necessary for ADM to always stay on their toes, to always keep up with the latest trends, and to focus on a highly efficient and productive business. If you do like the video so far, please smash the like button or even subscribe to the channel in order not to miss my next video. Before we jump into the detailed financial analysis now, let's have a look at the total return of ADM compared to the S&P 500. And over the last year we can see that ADM did underperform the S&P 500 by almost 50%. A big part of this difference actually comes from the huge dip we had after the scandal surfaced. Over the last 5 years, the performance of ADM also was subpar to the S&P 500. Here we had an underperformance of around 35%. Again, also, a big portion of this underperformance comes from the recent dip. And if we look over the last 10 years, the S&P 500 did actually also outperform ADM. So the past performance of ADM stock doesn't seem to be overly good. So the past performance of ADM's stock doesn't seem to be too good. The financials of the company also show a bit of a mixed picture. The total revenue over the last couple of years doesn't show a clear trend, but rather we see that it's going up and down and up again. The same is actually true for the net income and especially true for the free cash flow and the operating cash flow. Here we can see that the free cash flow and operating cash flow even has been negative in a couple of years. So unfortunately, neither of these numbers show a very clear and stable uptrend, but rather it all reflects the very cyclical nature of this business. The margins, on the other hand, doesn't look too bad. Even though the operating margins came down a little bit from their high in 2021, the net margins and also the return of invested capital are still on quite a high level, and all these numbers are actually quite okay for the commodity industry. The EBITDA actually also shows the same cyclical trend that we just saw from the revenue and net income, and we can also see here that it came down quite a bit from the very high numbers they had in 2021. The liability and debt of the company doesn't seem too bad. Here we had a peak also in 2021, 2022, but recently it came down a bit, although this is mostly due to the current liabilities here marked in red. The long-term liabilities actually sit at quite a low level, and if we subtract the cash from the long-term debt, it only sits at 2.2 times debt to EBITDA, which is quite a healthy ratio. The company has been buying back shares steadily, so with the diluted shares outstanding, we can see a definite downtrend here over the years. And as we also just saw from the last earnings report, they also announced a new share buyback program for the next 2 years. So we can definitely expect this trend to continue. With around $1 billion, the dividend paid sit at around 1/3 of the current free cash flow, which is also a very healthy ratio. When we look at the forecast of the company for the next years, it also doesn't seem to be too rosy, unfortunately. The earnings per share are expected to decline in the next years, and even though they are expected to increase a bit in 2025 and 2026, this increase is only very slight. The same is true for the revenue. Here we can see that from the numbers of 2023, it is expected to dip down a bit this year, but then keep stable around the same value over the next couple of years. So the growth of the company for the next years is expected to slow down quite a bit. The analyst expectation sits between plus 20% and minus 10% based on 17 analyst ratings, and the average sits at around the current value. so nothing to write home about here. We can find one of the reasons for this when we look at the food price index. And here we can see the nominal and real returns. And the food price has been sitting at a very high level around 2021 and 2022. And since then it has come down a little bit. And it is also expected to go down a bit over the next years, which definitely puts some pressure off ADM. But we can also see that over the long term, this has always been growing. And I would also still expect that this trend is intact and that this will grow over the next couple of years. Before we sum this up, let's also have a look at the valuation of ADM. And especially the values of the EV to EBITDA and price to earnings is sitting at a very low level. Actually, it is the lowest level we had over the last 5 years. For the price to cash flow, it looks a bit different. Here we can see the huge fluctuations we had in the cash flow and also the numbers that have been negative a couple of times. But in general, the price to cash flow also sits at a very reasonable level, around the average of at least the last 3 years. For my fair value calculation, I used the growth rates as expected for the next couple of years for the free cash flow and the net income growth rate. And for the multiples, I used the average values we had over the last 5 years. For the Gordon growth model, I used the current dividend payments and the dividend growth rate we had over the last 5 years. If we look at the very long-term dividend growth rate of ADM, it even was higher than 6.5%. So if you want to be a bit more optimistic, you can also correct these values a little bit. So with these assumptions, I come to a fair value of around $125, and by including a margin of safety of 20%, we are sitting at almost exactly $100. That gives us quite a bit of upside from the current value of $62. Please keep in mind that the growth is not expected to reach the same values we had over the last couple of years. So there is also quite a good chance that the multiples will also not reach the 5-year average values. To be very honest, I've got quite mixed feelings about ADM. On one hand, the company is one of the biggest players in this market and they have a very strong position. They are financially healthy with low and even decreasing debt, and they also pay a dividend with a yield of 3.4% right now. They also managed to keep their payout ratio with under 26% quite low. Just this year, they also got the status of dividend king, which means that they could increase their dividend payments every year over the last 50 years. Midland is a cyclical company, however, and even though the growth was quite nice in the last years, analysts expect that this will slow down a little bit, at least in the short run. I would also not expect the growth numbers to reach the same heights that we had in 2021 and 2022. But with their strong market position and their M&A strategy, I think the company can still manage to return good results over the long run. The thing that bugs me most is the current accounting scandal. Not because I think there will be a huge impact on the performance of the company, but because this scandal, combined with the other ones they had over the last decades, makes me question the integrity and honesty of their management. And I definitely don't want to be invested in a company that is known for its corruption, balance sheet frauds, and tax dodging practices. So even though I think that the company can keep compounding over the long run, and the current weakness gives a great valuation and is a good buying point if you are not worried about the management practices, I am not invested in ADM at the moment. But please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys. If you did find the analysis helpful, please smash the like button and subscribe to the channel in order not to miss my next video. And if you're looking for another company that might also be a good fit for your long-term portfolio, check out this video.